If you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're gonna speak today about a stock called ADM, Archer Daniels Midland agricultural stock, which, as you can see, has fallen from grace over the last few years. So after the initial drop, during the initial phases of COVID, the stock had a massive run up and had a fantastic rally, which came to an end in 2022. So post-COVID, there was an agricultural boom that drove record margins, but then everything went wrong. One of their plants had a fire, which cost $100 million and crippled their specialty ingredients. At the same time, North American soy processing plants suffer chronic breakdowns, and material weakness in financial controls spooked investors. Those factors led to this movement here, which we can see the stock going from just under 90 all the way to below 50 and more so just by April this year. Now, what did those things mean for the stock? Well, they had a margin collapse. The soybean crush margins plummeted from $70 to $40 per ton, and there was new capacity flooding the market because everyone built new plants during COVID. Then there was a biofuel policy chaos, crashing vegetable oil demand, and Argentina and Brazil expanded production, destroying global pricing power. So all that leads us to this year. If I switch to view here to year to date, you can see that the stock was flat in the first few months of the year. It was a little bit down around all the tariff chaos and has had a significant run up since. So it's gone from 40 to 62, which is a pretty big rally, 30% in the last 3 months, which is actually not far off many of the names that you would see in industries like tech. But let's take a look under the hood because this to me is a rally that is not really justified. There has been a lot of promises from management in earnings calls where they're talking about how they're going to cut 500 to $750 million in costs. But you cannot cut your way to growth. Then other factors that were the demise of the stock in previous years, such as the biofuel policy, have not really played out. And management also keeps recovering that the second half of the year will see a significant recovery on the business. But when you look at the fundamentals, margins and the business itself has not really recovered. They claim that operations are improving, but in reality, they're not really getting any worse. When you look at the Q1 and Q2 results, you can see that in one of the divisions, profits, well, actually, in some of the divisions, profits were down 52 and 17% respectively. Margins overall are still 40% below normal, and they guided to lower end of range. At the same time, they're still dependent on government policy that hasn't materialized yet. Now, I'm not saying that that cannot happen, but the market seems to be pricing that it's certainly going to happen. And this is a trade setup that I particularly like because it's a bit of contrarian. Um, but the reality is that the market has rallied quite a bit lately, and we could see some kind of correction over the next few weeks. At the same time, if you look at, for example, a couple of days ago, on Friday the 21st, Friday the 22nd, the market saw a massive melt up following the announcement from Jerome Powell that seemed to indicate that rate cuts are coming. And you see many stocks out there rallying 8% on the day. Actually, you don't have to go to fancy tech stocks for that. You could open up the IWM, which is the Russell 2000 ETF, and that ended up just about 4% up. But it was 8% on the day up. So, with all that, I do see some kind of reckoning that could be taking place for this stock. The reality is that there are more than 30 new North American crush plants built between 2020 and 2024. Argentina has expanded capacity 20% to grab additional market share, and Brazil is crushing at record rates. So the result of all that is margin compression until capacity shuts, and we don't know when that is going to be. Because the reality is that many of the emerging market economies are struggling, and this kind of commodity sector is one of their main engines. So there shouldn't be a reason for them to want to slow that down. Another factor that I see as a catalyst actually in this play is the end of the Ukraine war. We could see how a lot of progress has been made on paper between the US and the Russian administrations to put an end into this conflict. Now, that's a bit of a wild card because we don't know exactly how that's going to play out in terms of time. But what we know is that the margins from this company are artificially supported by dozens of tons missing from the Ukrainian supply. So any peace in progress should see an immediate grain price collapse. And when this supply returns, the margins could be crushed even more. Last but not least is demand destruction. We could see some consumers pulling back, such as big companies like Coca-Cola, ditching high fructose corn syrup. And if you look at the ISM manufacturing, you see that some sectors are actually not doing that great in terms of manufacturing. So paper, food companies, we historically have seen China being a player in this market, and now they they seem to make advancements to become self-sufficient in corn and soy processing. So the result of those things are volume declines accelerating while costs remain fixed. So how all this plays out? Well, we have earnings coming at the end of October. We could see some disappointment there, especially after the stock is up so much since April. So it's gone from 40 to 62. That's a 50% increase. And we could see a bit of disappointment there for that to retrace to around 50 around this level, which makes sense because it's about the level that the 250 SMA is happening, could be a little bit above. And also, we could see as well some further news from the US administration in terms of commitments to grain exports and so on. That is something that was widely anticipated by the market and could result in another disappointment as well. But at this price, I just can't see how the fundamentals support any kind of headroom for the stock. When you look at the price target, you can see that most of the time, let me go back a little bit more further back in time. Okay, yeah. So if we look a little bit further back in time, you can see that most of the time, this stock has been on the lower side of the target, right? The last time that it happened in the last 5 years was in 2022 when the market was extremely buoyant and the operation was on their side. The macro was bolstering their business. But we have seen that most of the time is really not the case. So I'll keep this on my watch list. Perhaps wait for a slightly better entry point for short. But I think it's something that would fit well with the macro and the rest of the portfolio. Hope you enjoyed the video. See you soon.